Hello, and welcome to another Private Markets Insider webinar. I'm Kevin McCaffrey with Private Markets Insider and LaCrosse Investments 37.4. I'm happy to be your host today, and I hope you're having a happy new year. If you were in the business of making predictions a year ago, you've been humbled. Now, don't worry, you're not alone. I imagine in writers' rooms all over the world, authors of thrillers and comedies alike have been fired for trying to tell tales as ridiculous as the reality we've just witnessed. So here we are now. It's the day after Groundhog Day. And looking back at measured financial models seems no more reliable than a groundhog's shadow. That's, not to say that you can't make money from, these various strategies. After all, you do have one potentially valuable piece of the puzzle. You now know we have 6 weeks more winter coming because Punxsutawney Phil walked out and was scared by his own shadow, right? And if you're confident in this pudgy prognosticator as your source, you can find ways to trade that valuable nugget in the public markets. And then if you're trading the public markets, frankly, you don't need us. But maybe you have your doubts. Maybe your time horizon goes beyond the useful life of advice enticed out of a sleep-drunk rodent. Anyone aware of the random walk theory worries that short-term market moves are about as predictable as a drunken man. So maybe you see fit to extend your time horizon, collect insights from others that have honed expertise over decades and committed capital to less liquid strategies for the sake of long-term results and some sense of sanity. Maybe you look to a select group of insiders in the private markets for a little advice. So maybe we can help. We're trying to do just that with thoughtful conversations that you'll be witnessing and building valuable community around valuable investments through the Private Markets Insider platform of webinars, summits to come, related content, and investment opportunities that we can bring to you directly. So let's get into it. First, a couple of program notes as we review the agenda. I'm going to share the agenda here for you. The following presentation is for informational purposes only. None of the information shared or the opinions given are to be construed as an offer to buy or sell a security. If you have any questions for the speakers during the program, please use the Q&A feature. We try to make this interactive. We will jump in and address a couple of questions. And we'll answer as many as we can here during the webinar, and we will follow up afterward to answer any remaining questions if you make yourself accessible, and we'll have those conversations where appropriate. So these and more details on the speakers that you'll see here are available on the website for Private Markets Insider. And now I'd just like to start with our first state of the private equity and GP stakes market. It's a fireside chat here with Wylie, Fernyhough, and Clark Edlund. Wylie is a lead analyst with Pitchbook, and if you're like me, you're using a lot of their tools, you're hanging on their reports daily to make us aware of some of the things that are going on, and he's very helpful. So Wylie will offer some data points to set some context here for his discussion with Clark Edlund, who's managing director at Kaz Investments, as well as the first, they're also setting context for the panel discussion that'll follow. So with that, I'll remind the audience to write in with any questions, use the Q&A feature, and please, Wylie, take it away.
Hey, thanks, Kevin. Will do. So I'll start this discussion off with a little bit of data to kind of set the stage for how 2020 turned out in the state of private equity, and then we'll dive into it from there. So, the big takeaway, I think, for 2020 was just how resilient the private equity market was. I mean, when we look at deal value and deal count in terms of buyouts compared to 2019, we were down maybe 5 to 7%. And if you told anyone in late March or April that that's what was going to happen by the end of the year, I think you probably would have been laughed out of your Zoom room, right? I mean, it's just wild how resilient, especially in Q3 and Q4, the overall market was. When we look at growth equity investments, so not control stakes, it was actually an all-time record in terms of the amount of capital deployed by private equity firms in growth equity. Another point that was interesting that we saw was that deal multiples were at an all-time high. So again, despite the backdrop of the pandemic, we actually saw buyout firms paying higher multiples on average than we've ever seen. The other interesting thing for me, at least, was on the exit market, we actually saw exit value in total rise in 2020 compared to 2019. And a good chunk of that was really riding the wave of the very healthy performance in the public markets, whether it was SPACs or IPOs in general. Private equity firms cashed in a lot of their portfolio companies on public markets in a way that we hadn't seen in almost a decade. And it looks like that's going to continue going into 2021. One last thing I'll touch on was fundraising. Fundraising in the US private equity crested $200 billion, which was down about 30% from the year before. But it was actually something we predicted, all the way back in 2019, just because there were so few of these really large $5 billion plus private equity vehicles in market, and fundraising over time just tends to be a little bit less smooth than deal making or exit activity. And for what it's worth, going into 2021, we're actually predicting an all-time high in terms of fundraising, and we're off to a pretty healthy start already. And so I think that's probably a good backdrop to frame the conversation. And then, Clark, I think we have some other things to discuss. But before we jump to that, I'd love to just maybe get your opinion on what was the one thing that stood out to you the most in the broader private equity landscape in 2020?
Yeah, it's a great question. I think the biggest thing that surprised us was just the lack of opportunities that existed in what a lot of folks thought would have been distress, right? I mean, coming out of the pandemic, it was amazing in terms of the number of sponsors that came to us proactive, looking to pivot within an existing fund to have some sort of sleeve or allocation to focus on distress, or literally started a brand new fund that was going to be focused specifically on stress or distressed assets. And then by the time the guys that weren't able to pivot within an existing fund and have some sort of dedicated allocation there, by the time they brought a new vehicle to market, it dissipated, right? It evaporated in front of our eyes. So the distress never came. So I think what's going to be really interesting moving forward between now and, call it over the next 12 to 18 months is, when does that pain actually settle in and where? And I think it's a really good segue to, I think, why a lot of people have actually looked at GP stakes in the sense that when you own an allocation to a specific sponsor, you're not necessarily taking that vintage or that timing risk, right? Because you own a piece of the house, you're sharing in economics across a lot of different vintages. I'd be curious just to get your thoughts on this, because it's something that we get asked a lot, given we've got close to $1 billion in assets in the ground in GP stakes specifically. How do you describe what it is? I mean, a lot of people don't even know what GP stakes are. Just in simple terms, what is a GP stake? How does it work?
Right, so it's a minority equity stake in the management company of a private capital firm. So it could be a credit shop, real estate, buyout, growth equity, venture capital, what have you. But yeah, it's a financial, investment into the actual house, and as you said, not the funds, which is what most people are going to be familiar with. So it's owning a piece of Blackstone rather than a piece of, let's say, their corporate private equity fund.
Yeah, I think that's a good way to think of it. Sometimes it's easier to just make that analogy and have them look through it through the right lens, in the sense that you've got public companies, you've got private companies, you've got publicly traded alternative asset managers like Blackstone, KKR, et cetera. And then you've got privately traded asset managers like many of the folks that a lot of us are aware of. And there's different sponsors that provide that access. So let's talk a little bit about maybe just some of the motivations behind why GP stakes exist. Obviously, in the public space, these firms went public because they needed growth capital because of the pure size. I mean, alternative asset management isn't overly different from a lot of industries, where if you've got a growing business, you got to feed it. Is that the same primary catalyst here, or are there other catalysts in play that would incentivize that dialogue with the sponsor to a staking firm in terms of why they would want someone to bring in that strategic capital?
Yeah, I think in a lot of cases, you're right. It's all about that strategic aspect of kind of taking the business to the next level. I think in some cases, especially on the larger end, you might see, a partner that's looking to cash out. But even then, these deals come with a lot of strategic value where these specialized firms that are investing in private equity firms. So whether it's Dial or Blackstone or Bonaccord, these guys, even if it's the financial aspect of it, they're bringing a lot of strategic value that helps the firms maybe launch a new strategy or understand and institutionalize their firm, help with succession planning, what have you. There's a lot there that kind of helps take these firms to the next level.
Yeah, it's a good point. I think one of the things we noticed early on in some of these conversations, and just to provide some context around this, at least for us personally, our initial exposure to the space is mostly focused in the large cap space, which is typically defined, I think by you guys at least, as kind of 8 to 10 billion in fee paying assets for the sponsor and up. So that's kind of the large caps. And I think that was the natural starting place for a lot of folks, primarily because it was the only place to acquire GP stakes. There's been an entire budding ecosystem of lower middle market, right? I think for us, when we looked at that space, it was interesting because of the fact that there's really only 3 players up there right now, right? You got Dial, you got Blackstone, and you got Peters Hill, which is a division of Goldman. And you're right, some of the motivations there were strategic in the sense that they may want to partner with one of those staking firms to help them accomplish something they couldn't do otherwise. But what was interesting is it felt like a lot of the early transactions, these were almost like replacements for IPOs. A lot of secondary capital where these sponsors were kind of taking, money off the table, if you will. And now it almost feels like there's a little bit of a shift to where we're seeing maybe a more even balance between primary and secondary. What do you guys see in there, and how do you see that changing between the large cap allocations, transactions that have been done versus where a lot of the attention is being paid, and certainly where we're spending most of our time today in lower middle market?
Yeah, I think that's definitely right, especially at the top end. It's a significant chunk of those deals tend to be, to your point, secondary capital. And I think the interesting and what a lot of people would say compelling reasons to look at the middle market space is that a lot of that capital is going to be primary. And so whether it's going on the balance sheet to, increase the GP commitment to funds, so, these firms are effectively doubling down on themselves, or whether it's going to launching new strategies or what have you, it's pretty interesting to be able to, again, share in the economics with these smaller firms that potentially have larger growth trajectories over time. And being there for partners that aren't looking to maybe just cash out, but really looking to effectively bet on themselves and really leverage that growth profile.
So you bring up a good point related to the economics, and I think this might be a key differentiator. And maybe we can talk a little bit about how private stakes compare to the publicly traded comps like Carlyle, KKR, Apollo, et cetera. In that regard, what do the economics effectively look like? Because most of the way these deals are structured is you're sharing in the top line economics of these businesses, which means you share in your pro rata share of the management fees, the carried interest, the balance sheet returns, and obviously own a stake in the enterprise value as well. I think there's a lot to be said for the benefits of owning top line economics as opposed to bottom line profitability. Obviously, there's a liquidity premium that exists for those rights, but maybe shed a little color there.
What do you mean on in terms of maybe return profiles or multiples being paid? Or
I think that would be helpful. Maybe both. So maybe a little bit about return profiles in terms of what that looks like, and then obviously maybe that delta between what we're seeing the publicly traded privates trade for in terms of acquiring those relative to the discount you get by taking those private stakes, large cap versus mid cap. I think would be helpful.
Yeah, so especially in terms of multiples, that seems to be one of the interesting things, is just how kind of wide the delta is. So if you look at a firm, maybe like EQT, that's trading close to 30 times their economic net income, comparing that to what you're paying for the large cap space, let's say that a deal that might go to Dyal or Blackstone, they're paying closer to probably 12, maybe 13 times. And so, significant discount. In all fairness, a firm like Blackstone maybe trades closer to 20, 22 times, but there's been a total re-rating in terms of these public GPs in terms of their multiples upwards in the last couple of years. And so we're
Out
seeing,
of curiosity, how much is that is just with the market going up as a whole? Or how static have those multiples been on forward-looking earnings for the publicly traded comps?
so I would say it's definitely been some of the market just going up. And I also think some of it is kind of a two-pronged thing. So I think it's also the market having a better understanding of how to value some of these firms over time. I think the C Corp conversions that these firms undertook was helpful. And I also think the general push towards a lot of these larger firms towards collecting more management fees rather than carry
Right.
has also been, pretty rewarded by a lot of these public market participants. And so, but what we see in the private space, especially in the middle market, when you're paying maybe 8 or 9 times economic net income on a forward-looking basis, it's a pretty attractive buy-in multiple.
Sure.
Not to mention the downside protection that you're able to get, just because, again, a lot of these, especially on the management fee side, it's contractually locked in. And so the downside case looks a whole lot different than what you might see in other areas of the market.
Yeah, it's a great point. What I think a lot of people fail to appreciate is what that true floor kind of looks like. And, the way we viewed it is, as you articulated at the very beginning, the growth of private or alternative asset management is only continuing to rise. We don't see that slowing down anytime soon. So in our opinion, it just made a lot more sense to participate on the house side of the economics, because everyone knows, GP economics are better than LP economics. And plus, you just have so many more dimensions of diversification. As I mentioned earlier, you mitigate a lot of the vintage risk, if you will. Not to say that this may not be a time to have a really strong vintage, across the board, irrespective of asset class. If in fact we do see some distress and these sponsors are able to deploy capital at very attractive multiples, but you've got vintage diversification, strategy, sector, geography, et cetera. There's a lot of different ways to slice it. And then of course, return distribution, I think, is helpful in the sense that you get your pro rata share of the economics across the board, fee, carry, GP commit or balance sheet capital, and then obviously sharing the enterprise value, which is, a little bit different from the publicly traded comps. I think it's actually a really nice pivot also to ultimately, how do these things monetize? I think early on, a lot of the challenge for investors, at least when they were participating in the large mega cap space, was how the heck do I get my money back? It's great if we have this really strong yield, given we're in a yield starved environment, and, given there's, no interest rates or zero interest rate environment. But how do I get my capital back? And it was challenging because most of these deals early on were structured in perpetuity. So there wasn't the traditional kind of 10 or 12 with a couple GP, 2-year GP options or something like that for extension. Now it almost feels like there's still a lot of uncertainty around exit, but not necessarily for lack of options. There's a lot of different tools in the tool belt. We're starting to see some groups, Dial's done. They did a dividend recap on their third fund on about 20% of their portfolio, which, resulted in a great exit and distribution, for their LPs, us included. They also sold down half their position, which was well documented in Silver Lake. That resulted in a nice exit. Maybe spend a few minutes just talking on about the different tools in the tool belt, how we see that coming together over the next 5 to 10 years as these funds become more seasoned, between management company buybacks, strip sales, dividends, sell to a strategic, sell to a public, whatever it may be. And then I'd be really interested on your thoughts on how the lower middle market could effectively sell to the large cap space, given the large cap space, it's pretty sparse at this point. There's 40, 50 names that haven't sold a stake or gone public. So you got a lot of dry powder, very few names. They got to put that capital to work somewhere. Lower middle market feels like the natural, next iteration in this arena.
Yeah, I think, there's definitely a lot to go off there. And I would say, of all the conversations I have with LPs on the GP stakes area, most of the time gets spent on how do you monetize this? And it's a question that comes up every single time. And it's one of those where, we can look back and see, to your point, there's been sales to another strategic, let's say, like, Dial selling half of its stake in Silver Lake. We've also seen, in one or two instances where an original investor sells a stake to another financial sponsor. And I'll get back to that one, why I think that's so interesting. In some cases, and it's really more on, the middle market, the smaller side, you could actually sell it back to the management team. And so that's happened a few times and, theoretically could happen again. And then, another one is through M&A. So whether that firm is acquired later by another, outside investor, and then they take that GP stake with it. And then there's also, the public listing aspect. When we get into some of the other financial or financings, whether it's a strip sale or what I call a structured sale, which we can get into securitization, securitizing these pools of cash flows effectively, just like you would a mortgage-backed security, dividend recaps. I mean, there's just so many options on the table. And, I'm sure the bankers out there are just salivating, wanting to be able to, structure it and sell some of these.
They absolutely are.
But I think to your point, the sale to other financial sponsors is really interesting, especially in the middle market, because we're seeing a lot of these deals start to occur in the middle market. And exactly, there's not maybe as many opportunities at the top end. And so it's going to come down to effectively Dial and Blackstone, maybe Petershill, buying from some of these middle market firms as they invest in some of these middle market buyout or credit or what have you shops, have them scale, and then effectively transfer ownership maybe to a larger player that is more well suited for that GP in order to help them go to the next level from there, and as well provide liquidity to LPs such as yourself.
Yeah, no, it's a great point. And just in the last couple of minutes here, I mentioned earlier, at the top end of the market, there's only, 40, 50 names left that haven't sold a stake and or gone public themselves already. So, I think some could argue that maybe some of the best deals have been done. Maybe not, we'll see. But because of that limited scarcity and capacity, if you will, and a lot of dry powder, we have seen multiples creep up a little bit up there. So to your point earlier, where you might see those trade at, between 12 and 15, 16 times or more in some cases, lower middle market tends to trade at a discount to that. And it's a lot of it's just simply around the supply demand dynamics, right? Instead of having 40 to 50 names to choose from, you might have a sandbox of 600 to 800 names to choose from, which clearly puts a lot of the negotiation leverage, if you will, clearly in the possession of the GP staking firm as opposed to the firm, selling a stake. And then in addition to the exit opportunities, at the large end of the market, let's face it, there's not a lot of natural buyers for a $75 billion asset manager, right? It's you likely go public or go public. There's really not a whole lot to do there. And then for the big guys like Dial, Blackstone, and Goldman, the likelihood of them coming down market, and wanting to do $125 million transaction out of an $8, $9, $10 billion fund, it doesn't move the needle for them. It is not worth their time. And Sean Ward, in our conversation with him at our annual meeting, 2 weeks ago, was on record. He said, we have no interest of going down and buying individual stakes, but they will absolutely take tranches, whether it's a securitization or some sort of strip sale of maybe a diversified portfolio of a lot of lower middle market stakes to be the same size of what would normally be one large cap transaction for them. So I think we're right up against our time here, Kevin. We'll flip it back over to you if you have a couple questions, or if we need to move on to the next group, that's fine too. But we certainly appreciate you having us, and thank you very much.
Yes, I did see a couple questions come across under the radar, but it was basically answered by some of the things that you mentioned. And this is really helpful context overall. And I'll just mention that Wylie has some incredible research that contextualizes all of this in terms of GP stakes and the different players, and really thoughtful. So you can reach out to us or to Wylie, and I'm sure he can get you some of that research. And Clark and Kaz are a client of ours at LaCrosse Investments, so we can give you a lot more detail. And we like what they're doing. We're only partially engaged to help them, but they're out there. So with that said, we will now move into the next segment, and I'll be handing this panel discussion over to Jonathan LaCrosse, founder of LaCrosse Investments 37.4. And Jonathan has a unique perspective as an LP and as a force for good in the fundraising game, I like to think. He put over $4 billion to work as an LP between his roles with Robert Wood Johnson Foundation for over a decade, and then working with CalPERS to launch Centinela Capital, focused on emerging managers. And then he founded Trusted Insight, and some creative ways to bring LPs and GPs together as he launched that media and screening platform. And shortly after that, he became a placement agent, and he's raised over $4.5 billion working in that capacity. So I worked with him over the years to assist with setting up LP meetings and road shows for some of his private equity and venture capital clients. And now I'm pleased that he's expanding his team. I'm working together with him in that capacity for LaCrosse Investments to leverage his experience and help more clients with a bit larger team. So Jonathan, please share any other relevant details I may have left out, and lead us in this conversation with your panel on private equity and private credit outlooks.
Well, great. Thank you so much, Kevin. And it's great to be partnering with you again on another fantastic webinar. So that was certainly exciting first panel there. Great to hear the insights from Wylie and Clark. So now we've got two other very distinguished participants here, and look forward to getting their thoughts on private equity and private credit outlook for the remainder of the year. So let me first introduce Mary D'Souza, and I'll give you a brief background on Mary. Maybe it won't be so brief, but I've got her bio here, and then I'll introduce David, and then we can get into some questions. So Mary is the Chief Investment Officer of Misha Investments, and she's also the CFO and Director of a biotech company. She has extensive experience investing in the capital markets, and over the past 20 years has structured, placed, or invested in a variety of structured products, bank loans, junior capital, high yield, early stage companies, real estate, and private equity funds. She has done quite a bit. Prior to Misha Investments, she worked for 3 years at 4M Investments, where she was also the Chief Investment Officer and CFO, and for that family office. She also worked for 9 years for GE Capital Markets, where she was responsible for running and establishing a junior capital business, and also set up the Unitranche Fund with Allied Capital, which was later sold to Ares. She has placed over $13 billion in volume with 150 plus deals, and in a lot of different areas. She has an MBA from Pace University and a bachelor's from St. Xavier College. Welcome, Mary. And then let me also introduce David. David is a founding member of Season Investments. Also, I'm based here in Boulder, Colorado. David's down the road in Colorado Springs. He serves as Chief Compliance Officer as well as a member of the Investment Committee, overseeing the management of client assets. David spent nearly 10 years in various roles, primarily managing individual client assets prior to co-founding Season Investments. He graduated with a degree in finance from the University of Colorado, Colorado Springs, and is also a chartered financial analyst. So without further ado, Mary, let's kick it off with you. What is interesting at a macro level in private equity, private credit today, as far as strategy, sector, size, risk position, et cetera?
Thank you, Jonathan, for the great introduction. And Kevin, thank you so much for including me in this timely discussion. In terms of the segments of the market that we are interested in. We are mainly interested in the lower middle market area because it's so underserved. And so whether it's private equity or private credit, we tend to play and invest in this area. And in terms of funds or managers, as you mentioned, I spent a lot of time at GE and I got to know both the private equity funds as well as the credit funds very well. And so, you know, it's a lot easier for us to make investments because it's a long-term relationship, as well as being on the capital market side. I got to see how these people did the underwriting and how they invested. So it's a lot better and a lot easier decision for us when it comes to investing, whether it's in private equity funds or whether it's in private credit funds. And like I said, because it's underserved, the lower middle market is underserved, that's the area of the market that we're most interested in. And we tend to work with managers that we've known for a very long time. We now have a very strong investment or credit culture. And it's a long-term relationship because, you know, these funds are like 10 years. And so you better be comfortable before you end up investing in any of them.
Oh, that's great. Thank you so much. And let's turn it over to David. David, what is interesting to season investments on a macro level, and in particular to private credit and private equity? Thank you.
Yeah, first of all, as Mary said, thanks for allowing me to be here. That conversation with Wylie and Clark was super interesting. And it's been a great event so far, and I'm honored to be a part, so appreciate the invite. At Seasoned Investments, we tend to focus more on what we would consider to be alternative spaces of private credit and equity. And that kind of gets into just our overall philosophy of where those types of assets slide into the overall portfolio management. So there are a lot of spaces that we like. One thing we do that wasn't mentioned in my bio is we sub-advise on a private equity fund that's focused in the healthcare space. And so that was one thing I put on the list that I think is interesting right now in terms of just something that's timely and kind of related to what's going on in the world right now, is hospitals. And not the hospital real estate, but the actual hospital operations. And if you know anything about that industry, you know, hospitals just got absolutely decimated in 2020. And the reason for that was that hospitals make their money on elective procedural volume. So surgeries, elective surgeries. And in that April to about July or August timeframe, overall elective procedural volume in the hospital industry just fell off a cliff. And that was due to two things. One was many state and local authorities put a moratorium on elective procedures with the thought that hospital capacity needed to be sort of frozen in time and reserved for what was expected to be a massive wave of COVID-related patients. That happened in certain areas of the country, and not every single area of the country experienced that, but certain areas did. But even on top of that, there was a consumer-based kind of a psychological impact of, with everything going on with COVID, there's no way in the world I want to go to a hospital right now. That's the last place I want to be. So a lot of procedures, you know, that were not mission critical to a person's health were deferred, were canceled, were delayed. And so the hospital industry overall lost about $200 billion last year from this. And McKinsey put out a report, and they speculate that about 80% of the procedural volume that was canceled is going to come back in 2021 and 2022. So there's this massive backlog of procedural volume sitting in the system right now that we should expect to begin getting released here as things return to normal in the coming months. So in the hospital world, you've got the major system-owned operators that are fine. They've got a lot of cash on the balance sheet, plenty of access to capital, and really high-powered lobbyists that are in Washington making sure they get their bite of the apple from all the CARES money and whatnot. But then you also have smaller regional surgical hospitals that are really good quality, really well run, but because of what happened last year, they're in a bit of a pickle and they're looking for recapitalization. So there's opportunities in either bridge loans or just straight debt or straight equity to come in and participate in these hospitals that are going to be back on their feet shortly and should see a resurgence in volume as things return to normal. So that's one little interesting pocket. Beyond that, we like both equity and debt opportunities in litigation finance, lending money to law firms that are backed by personal guarantees from the partners, and also backed by caseloads, or participating from an equity perspective in the outcomes of meritorious cases. We like certain pockets of infrastructure, particularly related to the build out of 5G and the build out of renewable energy power production facilities. And then there's a lot of just little esoteric music royalties, life settlements, trade finance, carbon credits that maybe don't fall into the traditional private equity and private debt asset class, but sort of do on the fringes.
Well, that's fascinating. Thank you, David. That love to continue that discussion with you. That sounds like you guys are pretty opportunistic there. So want to follow up on the first panel and talk about if there's any interest that you guys have invested or are considering investing in GP stakes in some of the larger funds that have been raised, and then whether you consider that a risky asset class or a safe asset class, given what you know at this point. And then maybe you can comment on other sectors that you find, David, you just touched on quite a few that some people would consider the alternatives to the alternative and bid on the margin, maybe even pretty risky. But what do you guys, Mary, maybe we can start with you. Maybe you can first comment on GP stakes and where you see them as far as risky or safe bets, and then any other areas within either lower middle market that you mentioned or other areas that you're looking at that are risky or safer bets for 2021.
And thanks, Jonathan. I think in terms of GP stakes, I think some of the very well-established fund managers are not going to give you a piece of the GP stake. So I think the funds that probably are open to GP stakes are probably funds that have not been in the market for very long, or funds that are having some trouble. And I mean, that's my take. And David's take could be something different. So we would look at that very selectively. That's not an area of focus for us, but if an interesting opportunity presented itself, we would take a look at it.
So what within the lower middle market, Mary, do you consider risky versus safe, or maybe other areas? And maybe you can also, some people would say biotech is extremely risky. And also, given you're CFO of a company there, maybe you can comment from that angle as well.
Right. I mean, in terms of the biotech, it's our own family's company. My brother-in-law started the company, and he is very, very, what would I say, disciplined about how he does it. And we've self-funded this company for 10 years. And we are in the animal health space. We partner up with large pharma, so we don't compete with them. So we have their muscle behind us. And so we've done it very thoughtfully. And so I'm very comfortable being the CFO of our own family's company. In terms of lower middle market, it all depends on who the fund manager is and the principals within the fund. I think there is a lot of experience needed, and a very strong credit culture, investment culture to do that. And so we do a lot of diligence on these funds, and we only invest in them if we think our interests are aligned. That is, so we look at how much of their own personal wealth they have in their funds. and how they treat the employees and how long the employees stay with them and if they're incentivized, because it takes all of that to make good investments. Because if the incentives are misaligned, then you're going to find, investments that are not good investments. Because if the compensation is based on how many investments they bring in and not on the outcome of how these investments pan out, and if they don't have their own network tied up with it, it's not going to be as as profitable. So yeah, I mean, one of the funds that we're interested in is Star Mountain Credit, and I've known the principals since they founded the fund. So it's been a very long-term relationship, and since they have a lot of their own network tied into it, we were comfortable investing in several of their funds. And we invested in growth equity, we invested in bridge, real estate lending. So the various sectors and various asset classes that we invested in that we're very comfortable with, and we've had long-term relationships with the funds.
That's great. Thank you so much, Mary. So David, let's turn it back to you. Yesterday, you had mentioned to me that your firm focuses on what you refer to as alternative credit and equity, some of the strategies you mentioned before. So morally, a narrowly defined segment of private credit and private equity. Do you want to just expand upon that a little bit more outside of what you did at the onset?
Sure, and I'll try to dovetail that into your question about kind of risky versus safe end of the spectrum out there. Because, like you alluded to, on the surface, a lot of what we're investing in feels so esoteric that it's automatically assumed to be risky. But when you look beneath the surface, a lot of the stuff we believe actually has not only a good risk return profile, but it actually resides more towards the safe end of the spectrum in many respects. The third leg of the stool, so you've got return, risk. The third leg would be correlation and how it fits in with everything else in your portfolio. So sometimes it in and of itself might be a medium or high risk asset, but it can actually not necessarily be adding a whole lot of risk to the portfolio because of the lack of correlation. But three specific examples I'll just touch on real briefly. I mentioned infrastructure, so cell towers and the related types of infrastructure that are tied into the rollout of 5G across the country. This is kind of a hybrid real estate. We put it more in the private equity category based on the assets we're in. And then renewable energy production facilities that have long-term power purchase agreements in place with utilities and municipalities. These are never going to be home runs, but they're giving us really safe kind of singles with the opportunity for the occasional double or triple. So, and importantly, if you look at the pandemic-induced sell-off in March and April last year, these assets just kept chugging along. They're not being driven by the same cyclical factors that are driving stocks, bonds, and real estate. So from that perspective, they're a great diversifier to the portfolio. Life settlements is another one. Life settlements, if you're familiar with it, is just buying a portfolio of permanent life insurance policies. Only 15 to 20% of permanent life insurance policies ever actually pay out. So there's a saying that says life insurance is sold, not bought. Most people don't really understand what they're buying when they buy it. And so more than 80% of these policies end up being surrendered or lapsing. So a life settlements fund will come in and say, hey, instead of just giving this away, we'll buy it off you. So it's a win-win. The policy owner ends up with more money in their pocket, and the life settlements fund can build out a portfolio of these policies. And as long as they're underwriting them properly, they can gauge with a relatively tight band of certainty what the IRR is going to end up being. There's a lot of ways, a lot of potholes to step in there. So it all comes down to managing cash reserves, because you have to service the premiums on these policies, underwriting the lives themselves, how are you going to value the policies on the book? So there's a lot of life settlement offerings out there that we don't like because it's done incorrectly in a lot of scenarios, but there are some good opportunities to get exposure to that. And again, that the fundamental risk return drivers for that asset have nothing to do with whether or not the stock market is up or down, or whether or not the economy is doing well, or if there's inflation or low interest rates. It's completely structurally uncorrelated. The last little example, if I have time, is a litigation finance manager that we're invested with. And just as a microcosm for what they do, they're investing more on the equity side. So as an example, they might find a US-based small textile company. And this textile company has a particular piece of IP or patent. That IP or patent is being infringed upon by a massive Chinese company. Again, completely theoretical here just to illustrate what's happening. The small US-based company, as anyone who's ever run a business knows, there's only so much capital and time and energy to go around. So sometimes you just can't pursue legal recourse against a larger, more well-capitalized entity that might be infringing on your intellectual property. So what this group does is they have a team of lawyers who come in and underwrite the situation and basically say, we've identified this infringement. It's a slam dunk. We're 85% sure it's going to settle. It's just a matter for how much. We will, as an equity investor, fund and run this entire litigation for you. And when it settles, we get our piece and you get your piece. So the textile company gets their IP protected. They get a piece of the pie when it settles, and they don't have to put up a dime or do any of the heavy lifting to make it happen. And this company, you know, it's got a very high hit rate. It's got very nice return profile. And once again, their success is contingent not on the same types of things that are driving stocks, bonds, and real estate. Now, ironically, COVID, you know, which impacted everything last year, also impacted the court system. So a lot of things got delayed, and there was, you know, the timelines were extended. So that was sort of a surprising way in which, you know, there's always the unknown unknowns that might come in and impact things in ways you don't expect. But those are the types of assets that we're looking at to build a sleeve of private equity and private credit that's intended to add robustness to the overall portfolio and intended to create a return stream that's just going to be less volatile and more consistent over time.
Well, that's fantastic, Dave. I love hearing that people are investing in those areas. We see different strategies like that come in all the time, and a lot of LPs out there, at least on the institutional side, it's too far on the margin. So glad that you and your clients are investing in that space. We did have one question come in. So audience, please feel free to write in on the Q&A. We'll try to get to those. But before we do, we wanted to talk about a four-letter word. Well, maybe it's not an actual word anymore. It's an acronym. But it's the hottest area that you see in the paper every day, called SPACs. And I just saw that some political folks who just left office, including Wilbur Ross, just formed another SPAC for his firm. So it seems like if you don't have a SPAC, you're not cool. So and a lot of different areas. So love to get your perspectives. Mary, what are your views on SPACs? How long can this trend continue as an exit strategy for so many different private companies out there?
I think this generation of SPACs are much better structured than the previous generation. And some of the sponsors are a lot more stronger. And some of the companies that have been taken public through these SPACs, they're in the growth area, whether it's electric vehicles or green energy or fintech. And so investors have the opportunity to participate in it early, as you know, especially retail investors. They don't get a chance to do venture capital. So this is their way of getting exposure to venture capital, because some of the companies are very early stage and also very high growth companies and growing, technology areas. So I think it's a positive phenomena. And like any other phenomena, there's the good side and the bad side. And there are strong players and there are going to be weak players, and there'll be great companies coming public through the SPACs, and sometimes maybe not so great companies. So we've loved investing in SPACs, especially in some of the EV companies and some of the green energy and fintech area. And we will continue looking at some of the stronger sponsors who have very, very experienced investors in that space. And I think it's a great avenue for companies to go public, because these companies could not go public through either direct listing or the IPO market.
Great. Well, thank you. David, what is your perspective on SPACs? Are you investing in any SPACs today as part of a GP for some of the sponsors who need to put up their capital? And what's your view as far as how long this trend can continue?
Yeah, I mean, I'm not going to profess to have a very deep knowledge of this market right now. Ironically, when I started my career, I was an analyst at a firm that actually ran a SPAC portfolio, and this was maybe 12 or 14 years ago. And then I kind of forgot they existed until just recently. So it's almost like Mary alluded to, I'm not sure that the previous version versus the current version, what the differences are, but it seems like they were hot for a little bit about 10 or 15 years ago, and now they're back. And I do think it's an interesting way for a lot of different types of companies to pursue a transition to being a publicly traded company. I think just at a very anecdotal level, I tend to mix in those headlines about SPACs with other types of headlines that we're seeing right now that have to do with lots and lots of eager capital coming into really hot pockets of the market. So I'm having a hard time not sort of viewing that space as an example of where there's a lot of exuberance and maybe some froth. I think what Mary mentioned is there's the goods and the bads, and so it's a matter of really sifting through that. I did see one interesting one is that Simon Property Group, which is the largest or maybe the second largest mall operator in the country, just formed, I think, a $300 million SPAC, which is interesting to me because Simon Property Group, if you look into that company, their management team and the pedigree and the track record of their management team managing through this major secular transition we have and what retail looks like, they're fantastic. And they're spinning up a SPAC now to go invest in innovative retailers. I just found that interesting because you've got stodgy, old school mall guys doing a SPAC to invest in an innovative retailer. I'll be curious to see what it is that they invest in and how they dovetail that into their REIT.
Yeah, fascinating. Well, thank you for your perspective. We couldn't address what's going on in the private markets without touching on SPACs. I know we have about 5 minutes left. I do have a question from the audience. Mary, this is directed to you. How are you developing relationships with GPs in this COVID environment, if you are at all? Because you had mentioned earlier that you're primarily investing with those you've had a long-term relationship with. But are you giving any attention to newer sponsors, newer GPs, and how are you getting comfortable with them?
Sure. Like 2 years ago, we invested in a newer GP, and we're watching how it all plays out. It was not very fortunate for them that COVID happened last year, especially when you're a new GP. The way you get exposure to newer GPs or funds is through other family offices. We all tend to work together. So if someone sees some fund or GP that they're really interested in, they'll invite you to take a look at that alongside them. And so you get to do diligence with other family offices. So you'll see something that they don't see, and they see something that you may not, get in your diligence. So it's very helpful for family offices to work together, and that's how we do that. And you meet GPs through, through venues like this, through other conferences. And even though there hasn't been on-site conferences, there have been quite a few virtual conferences. So you get to learn a little bit more about them through those particular avenues too. And if you like a strategy or a fund or the way they're doing things, you'll reach out to them. Or when they reach out to you, you'll spend more time with them and get to know them over a period of time and decide to invest.
Great. And David, how have you been meeting with GPs and some of these groups that are in litigation finance or life settlements, et cetera? Is it primarily been through the videos like this, or have you been getting on the road? And how would, we have a lot of attendees on here, and how would somebody want to reach out to you and start building a relationship?
Yeah. My business partner, Elliot, is our CIO, and he spends 90% plus of his time just in due diligence and looking and scouring the earth for good opportunities. So he's on the road a lot. He's on conferences all day, every day. He's on phone calls, similar to what Mary described. He's got a lot of those relationships where they're sharing ideas constantly and looking at things together. So very, very similar there. And Jonathan, I don't know if there's a minute here at the end. I actually have a question for Mary, if we have time for that.
Yeah, go ahead.
I found it interesting in Wylie and Clark's conversation that the notion that we were all sort of getting ready for a bunch of really distressed opportunities last spring and early summer, and then they kind of never materialized. I think the physician-owned or regionally owned boutique surgical hospital is a little pocket in the market where I see some good distressed opportunities. Question for Mary, do you see anything out there in private equity or credit that you would classify as distressed and opportunistic right now?
I think what you're referring to is really interesting, because I not really think there's an opportunity over there, but an opportunity to do it better, especially if somebody is smart enough to aggregate it and probably run these hospitals and all these different healthcare systems a lot better than they're being run, because there's a lot of inefficiencies out there. But I also see some opportunities in the real estate space, right? Especially the hotel space, because they've been over levered. They have no way to generate revenues right now. And I think there'll be some very interesting opportunities in that space. And also in the real estate bridge lending area. And then I was very interested when you talked about litigation finance and also life settlements. My question to you is, how have life settlements performed? They probably have done better, right, in this environment?
It's like they weren't aware of COVID. There was maybe a little bit of speculation early on that, pandemic obviously will lead to higher death rates. And if that really gets out of control, then a portfolio of permanent life insurance, which tends to be insuring more elderly, within 5 to 10 years of typical mortality rate type insureds. We didn't really see that materialize, but there was a little bit of speculation early on that how is this going to impact that space? But for the most part, that space has just kind of plugged away and hasn't really skipped a beat.
Okay, no, because those are two areas that we were interested in, because we don't see any correlation to the rest of the market when it comes to those two asset classes.
Yes.
Yeah, well, this has been a fascinating conversation. I have a bunch more questions here. I'd love to ask you guys, but we have hit the top of the hour here. So we have got a few more panels here. So I'm going to turn it back over to Kevin. But thank you so much, Mary and David. Very insightful comments. We appreciate that.
Thank you.
Thank you, Jonathan.
Yes, thank you all. And it's interesting to see how readily that transitioned into some of the real estate and real assets discussions we'll be having here. So thank you for all of that. And now let's shift gears and dig into the arena of real estate in particular. But in order to set up that conversation, we have one of our webinar chairs, Ed Stanton, here to create some context with a short presentation on the state of private real estate seeking quality yield. I think we're all, starving for yield these days, and you hear a lot about that. You heard some of that addressed just there. So Ed Stanton is the co-founder and managing principal of Gray Harbor Capital. Mr. Stanton brings over 20 years of commercial real estate investment experience to Gray Harbor. For the past 11 years, Ed has focused exclusively on GSA real estate investments, and he's directly responsible for the development and implementation of the company's corporate investment and capitalization strategies. Mr. Stanton, his previous experience includes co-founding HC Government Realty Trust, HCGRT, Federal Government REIT, where he served as director and CEO. He was also founder and president of Homewood Capital, the predecessor to HCGRT, where he was responsible for the development and creation, implementation of the company's investment and capital structuring strategies. So you're seeing a thread here. He's collectively, through these efforts, acquired and managed 17 GSA leased properties representing more than $100 million. And Ed previously founded other private real estate investment firms. And over the course of his career in general, he's transacted on more than $1 billion of commercial real estate. He also holds an MBA from Georgetown University, and I'm sure he can fill in a couple other gaps that are relevant here as part of his notes for us today. Ed, if you wouldn't mind sharing your, I see you've got that up on the screen, and please take it away.
Great. Thank you, Kevin, and I appreciate the opportunity to be here today and talk a little bit about a sort of specialized and niche asset class within the commercial real estate sector. So just to kind of jump in a little bit, thank you for the introduction on the background. And as you mentioned, Kevin, so 20 plus years of commercial real estate personally, with the last 11 years focused exclusively on the federal government leased real estate space. Gray Harbor Capital as a company, we're a pure play investment sponsor, real estate investment company focused exclusively on federal government leased real estate. So this is all we do. It's a specialized asset class, but we feel that being a pure play investor in the space gives us some advantages in negotiating and understanding sort of the federal procurement process and lease renewal structures and obviously managing a wide variety of federal government leased tenants. Our team brings over 125 years of commercial real estate experience, with 60 plus in the federal government lease space. And we're a fully vertically integrated organization, so that we handle our capitalization needs in-house, our acquisition investment, as well as asset and property management and development. So with that, I'll kind of just jump in a little bit about the market opportunity that we see and what we like about the space. A lot of people aren't aware that the federal government leased real estate space exists at the size and scale that it does. The federal government has moved largely to a lease versus own structure, which has allowed them to expand services and specific agency missions across the nation more efficiently, and to stay within budget requirements versus building and owning all of their own buildings. So once you get outside of the major metropolitan markets, particularly the Washington, D.C. and a Beltway area where the federal government has significant real estate holdings, and you get into secondary and smaller markets around the country, this is where the federal government relies exclusively, in most cases, on the private sector for the various real estate needs that they need for various agencies and missions. So they're obviously a massive tenant. They spend over $5.7 billion annually in rent. And so to provide some perspective for that, that's larger than the office markets in LA, Chicago, Houston, or Boston. Not in aggregate, but individually as large real estate markets. It's a very inefficient and fragmented marketplace. Largest single GSA owner in the country owns less than 4% of the total market. These are really a fragmented and regional developer play and ownership play around the country. The needs have steadily been growing, right? And so this is a market where we see, administration agnostic opportunity. These are mission critical, essential citizen service function type facilities that, irregardless of whoever's in office, it doesn't really have an impact on the type of properties that we seek to acquire. It's a really kind of a arcane and complicated process of dealing with the federal government. Obviously, as everyone can imagine, the red tape involved in the layers of bureaucracy that span across all levels of any type of procurement through the private sector for the federal government, and that's no different than for the real estate space. But it's one of those things, as more time in the market, more time working with these types of tenants and with the federal government as a whole, that we've been able to sort of figure that process out. And obviously there's always things new to learn every day in the space. And it's a really expansive market as well. So obviously we target all 50 states and US territories. And as I mentioned, we as a firm focus on sort of a niche within the niche, which is the smaller secondary and tertiary market properties. And again, that's to provide sort of the insulative properties to lease renewal. Just to kind of quick click through here, what we see this as primarily as an arbitrage on credit, right? So we're looking at current yields, net yields to investors of say 6%, whereas public office REITs are yielding in the 4 range. The 10-year Treasury just kind of peaked up above 1% lately, but has for the last year plus been below 1%. And so when we look at that arbitrage, we're saying, okay, great, for the exact same credit opportunity, for the same full faith and credit of the United States of America, we're looking at anywhere between 400, 500, 600 basis point spread between a Treasury, a 10-year Treasury, and an equivalent 10-year federal government lease. And obviously there's components of that are not equivalent to buying US Treasuries. You don't have the liquidity, you don't have guaranteed bond repayment. But given that these leases have high renewal probability and are long-term built-to-suit projects to meet the specific needs of agencies, they're highly sticky tenants. Additionally, obviously, this has a low correlation to public markets, and there's opportunity as we build portfolios to create additional value across this asset class through aggregation premiums. It's an easily financeable market, obviously with the credit and the long-term nature of these leases. It's attractive to lenders. So in this current marketplace, when a lot of other asset classes may have been seeing some headwinds, we haven't experienced those issues with the federal government lease credit. And that's kind of just take me to my last slide, because I know we have kind of a short presentation time here, but talk a little bit about these the insulation of these sector headwinds. We're not really looking at a lot of the same issues that other asset classes are facing, particularly over the past few years. And that's not to say that other asset classes aren't valuable and shouldn't be invested in. We believe across the full real estate, commercial real estate spectrum. But federal government is unique in that it's not facing, budget restrictions. It's not facing, COVID restrictions. We haven't seen any of that over the past year. And really, I think, the internet component as well, as we've seen effects on retail and things, has not been, again, an issue for us in the federal government space. And so we see this as a component of commercial real estate investment that would be accretive or additive to a general investor's platform in commercial real estate. They're going to want to be diversified across the major food groups. And so, really our goal is to sort of get some information out and make the opportunity a little bit more visible for investors who are looking for some additional ballast for their portfolios and for their commercial real estate holdings to have, the most secure, highest rated credit that you can have. And really the only tenant that if they run out of money can print more. So that's kind of a nice component of them. And lastly, I'll just kind of leave a contact thing up here and open it up for some questions as we try to stick with our time frame here.
Yeah, thanks a lot, Ed. And I did have one question come in. You started to essentially answer that with your, last comments around diversification and so on. And by the way, I'll just mention to everyone, if you would like to reach Ed, feel free to contact us and we'll put you in touch. But Ed, I would ask that you take the presentation down at this stage only because we need to shift some people for the upcoming conversation. And meanwhile, while we do that, you could answer the question, are investors using GSA leased ops opportunities mostly for diversification? You started to kind of handle that, but as a part B to that, where does this fit into a broader portfolio? Yeah, how are you seeing people, adjust real estate as part of that and GSA within real estate?
Sure, a great question. And I think it's there's kind of a two-part component to federal government leased real estate. You've got the traditional real estate, the brick and mortar component, the fee simple nature associated with the actual the property itself that's occupied by one of essential citizen service or mission critical agency. But because of the credit and because of the long-term nature of these leases, you've got kind of a fixed income alternative play here as well. And then within some of that, within that space. And so I think, it's one of the asset classes within commercial real estate that spans outside for investors beyond just real estate and could look at an alternative for, say, corporate bonds or other vehicles that they're looking at for fixed income, and look at federal government leased real estate as maybe a supplement to that as well.
Yeah, thank you. And another question came in wondering if these leases tend to be triple net.
So that's what makes these leases a bit more complicated. They're about 2.5 inches thick. They are modified flat gross leases. And so they're more bond-like in their structure and the payment, as far as they make a set payment every single month. It's up to the manager and the owner to manage expenses. There are some increases that are passed through annually on expenses that the federal government picks up. But largely on these assets, where you see your rent growth is upon renewal. Federal government has a 95+% annual year-over-year retention rate on their leases. So likelihood is high for renewal. But after a 10-year lease or a 15-year lease, that's where you're expecting to see your rent increases upon renewal to bring them to market.
Okay, and a follow-up is, what is the average lease term and the renewal rate? Sorry if you might, you started touching on that. Go ahead.
Yeah, federal government typically leases 5 to 20 years. 20 years is their max. Most of the assets that we acquire are 10 to 20-year lease terms. And what we see historically and the data that's provided by the federal government to the public markets is, that there's a 28+ year average occupancy in these buildings because they're built to meet the needs of the tenant. And so for the tenant to move, they'd have to find another facility or build one, or take an existing facility and refit it to meet the needs. And so you've got additional future costs of those TI dollars and construction costs, not to mention disruption costs in moving their location.
Okay, great. And I'll make this the last question. Why is the federal government paying higher rents than private sector office tenants?
Sure. And so the federal government lease has multiple rent components as part of their gross rent. One of the part that makes the overall gross rent higher than other sectors is that the federal government finances all of the tenant improvements down to the kitchen sink, literally, into these leases over the long term. It allows them to spread the costs and their participation of tenant improvements that they need for specific agencies to participate in that, instead of having to write a lump sum check, which they do in some cases, but to spread that over the term of the lease.
Great, thank you. And you'll have a chance to maybe mix a bit more of your perspective here into the oncoming panel discussion, since you're one of our panelists, and taking over that discussion on private real estate and real assets outlooks will be our moderator, Mike Kinney. And Mr. Kinney is the founding principal of Capital Group, LLC, a boutique investment sales consulting firm that focuses on designing business development and capital market strategies for all under the radar asset managers, real estate private placements, nonprofit organizations, startup ventures, and social impact investments. Mike has worked with a range of institutions, including Nuveen, Van Kempen, American Realty Capital, and he has successfully raised more than $2 billion from both public and private sectors. He was also very instrumental in pulling together speakers for this panel and working with Ed Stanton here to develop this conversation. So with that, Mike, why don't you please take it away?
Yeah, thanks, Kevin. And again, a special thanks to Ed, for honoring your commitment to join us today. I know you got a lot going on, and with the recent loss of a family member last week, so it means a lot. Really appreciate you taking the time to join us and share. Definitely a unique strategy, right? That, like Clark mentioned earlier, meets a need for yield in the marketplace. So, our thoughts and our prayers continue to be with you and your family, Ed, and really appreciate you taking the time to share with us.
Thank you, Mike.
You bet. Yeah, good morning, afternoon, wherever you're calling in from. Thanks for allowing us to participate. We've got some highly intellectual, very experienced panelists joining us today. I want to kind of kick it off and let them introduce themselves, talk a little bit about who they are, their firm, their role within the firm, and then maybe at a high level kick off. First question I would have to all the panelists, and that is, what are they kind of seeing from a macro level in terms of unique opportunities, or maybe even contrary to that, what kind of keeps them up at night about the current macro environment? And we'll start with Sam Isaacson with Walker Dunlop. Sam, I know you kind of have a different vantage point, right? Where you guys obviously have a global presence, and you spend a lot of time on both the debt and the equity side of it. So kind of tell us a little bit about yourself, Walker Dunlop, and then what are you guys seeing in terms of the macro environment that either gets you excited or keeps you up at night?
Yeah, thanks, Mike, and thank you, Kevin, for having us. So just high level, so president of Walker Dunlop Investment Partners. We are the investment management arm focused on middle market U.S. commercial real estate. We're the investment management arm of Walker Dunlop, which is publicly traded, one of the largest commercial real estate finance companies in the U.S., over 1,000 employees, one of the largest lenders for Fannie, Freddie, HUD, and then we've got our capital markets business and our institutional sales business, along with a variety of other businesses at the broader organization, within the broader organization. I will say we're obviously residential and industrial continue to be very, very strong in terms of investor demand, and we're seeing tremendous amount of deal flow in that space, just both on the debt and the equity side. It has been soft in some of the other sectors. I think from WDIP's standpoint, we're out constantly in the market raising different vehicles for different strategies. We kind of look at the world right now, high level. Yield is very expensive to buy, obviously, with cap rates having compressed further since COVID started. We are definitely risk off, in terms of taking, we don't want to take, a lot of our investors that we talk to don't want to take equity risk on core assets, but, we're taking more equity risk on a more opportunistic deals where we can actually manufacture yield. So if we're in core or core plus, we're taking more of a lower position in the capital stack, just given the fact that there's a lot of uncertainty around NOI right now across commercial real estate. Other than maybe Ed's portfolio, I think a lot of the other sectors have a tremendous amount of risk, and so we are being very careful in taking a ton of exposure to kind of last dollar NOI risk, except for if we are actually manufacturing that in an opportunistic or value add kind of risk profile. And there's a lot of that's just starting to come. Hotels obviously have been really, really hammered, and retail is totally transitioning. And then, and then obviously the industrial sector is continuing to see a complete it's been the darling for a long time, but it just tremendous tailwinds that we continue to see in that sector. Lastly, I'll just say, there's a lot of repositioning that's going to be coming, and there's a lot of property owners that are plugging the dam with paper towels right now. And I don't, I even in the multifamily sector, in the Class C, particular kind of workforce housing space, we are seeing some very interesting issues that are starting to kind of come to the surface. Not from a debt standpoint, but if you're an equity holder, you got to start to be thinking really carefully about what's coming potentially.
Yeah, great, Sam. Thanks for that. I think what you'll find across the panel, obviously, is some intellectual capital and great insight. And Sam did mention the fact that he's got an MBA from Wharton as well as a law degree. So really appreciate your insight there, Sam. Next up is Stu Kaplan with Apex Financial Advisors. Stu, tell us a little about yourself, right? You obviously come from a different vantage point as a CIO of a multifamily office where, real estate might just be a sleeve or an allocation, to an overall client's portfolio. How are you guys looking at the macro environment, from an overall portfolio allocation, and how does real estate play into that as you allocate client portfolios?
Sure. So as Mike mentioned, I'm with Apex Financial Advisors. We're a multifamily office based outside of Philadelphia. Our asset base is leaning more towards alternative assets over the course of the last cycle, which I'll say the last couple of years, I guess. They like in a low yield environment to have the opportunity to seek income and returns in private deals that are less, when you look at the actual risk on them versus what you're actually seeing in the market, they're very parallel. So from a macro environment, we like what we see right now, but again, as to reiterate what Sam was just saying, we're kind of hesitant to jump headfirst into anything at the moment because of the fact that we think a lot of people are being, held up by air and smoke and mirrors, or just kind of, biding their time. So we're being very cautious at underwriting deals. We're making sure that our numbers are right, and we're making sure that the leases are good. We're making sure that everything is completely kosher and up to speed. Real estate's a big allocation for us. We think it's a good, inflation hedge, a good value creator, a good, income producer. But you have to be careful. You're committing a lot of time and effort to these buildings. They're long-term investments. It's not something that you're buying and selling in a couple of minutes. So we have to be extra cautious.
Great, thanks, Stu, for that. Back to you, Sam. You kind of mentioned a few of the sectors you guys like. Obviously, Walker & Dunlop has a pretty wide base of investor types, from foreign institutions to pension plans, or insurance companies, family offices, high net worth individuals. And really, you guys have mandates through funds and SMAs kind of up and down the risk spectrum. What are you seeing from those different types of investors as far as appetite for risk? Right, and more specifically, which asset types are you spending most of your time kind of underwriting and recommending for clients?
Yeah, so it's kind of a mix. I think on the in terms of where in the capital stack, there's obviously a lot of interest in the debt side right now. I think a lot of institutional investors are concerned about where we are at from a broadly speaking within commercial real estate. It almost, if you look at, go from core to core plus to value add to opportunistic, that most of the equity that's being raised, or at least that we're seeing, or equity that's interested in terms of what like true JV equity investments, is merely more on the value add and opportunistic side. We're seeing less interest in any sort of core or core plus pure equity. Now there's a lot of demand for core plus preferred equity as well as kind of bridge debt or senior debt. in terms of the sectors, industrial and residential are pretty hot still. We are, within residential, there's less interest in a lot of the urban areas for obvious reasons with migration out of a lot of the urban core with COVID. Tremendous amount of interest in some of the SFR and BFR strategies on the single family side, as well as manufactured housing. We're seeing pretty big, that cap rates in manufactured housing completely have compressed, significantly, probably more so than almost any other sector. And then, office, I would say there's probably the least interest in office, generally speaking. People are very concerned about, what happens to office, what happens to a lot of the leasing within office. And it's a little bit hard. I mean, everybody's pontificating about whether people go back to work and we need more office space, or we don't go back to work, we need less office space. Nobody really knows the answer to that. And I don't mean that disrespectfully to anybody. And I think it'll play out over the next few years as those leases start to roll. But that's a lot of institutional investors kind of have that same view. And then retail is going to be probably the heaviest lift, if you will, of all the sectors, because it's just a tremendous amount of repositioning that's going to need to happen. And then, hospitality, we see a lot of opportunistic investors that are interested in hospitality right now. We're not quite there yet. I mean, the floodgates haven't really opened in hospitality, but it feels like we could. I mean, eventually when the PPP loans stop and, a lot of these property owners aren't able to get government kind of bailouts, if you will. And if at that point occupancy hasn't started to pick up, there's going to be some real interesting opportunities. But I would say, just to kind of bring it full circle, right now, generally speaking, there's a lot of interest in debt, and then there's more and more interest in kind of building up dry powder for opportunistic kind of strategies. Is kind of what we're seeing.
Yeah, a quick follow-up to that. I know we've talked this in the past. You guys have a significant amount of dry powder on the sidelines. Have you seen that been able to change, I guess, over the last couple of months? Are you guys putting money to work in specific asset types that you've been talking about?
We're putting a fair amount of capital to work within, as preferred equity within multifamily. We still like the residential sector a lot, and we like multifamily a lot, even despite my comments earlier about some of the workforce housing risks that could be potentially be out there. We still like it as a preferred equity position, just given that the macro demand for housing continues to be very, very strong, and we don't have the oversupply that existed in 2007. And then industrial, we like industrial a lot, and I know it's been, pricing has gone up significantly, but we're continuing to find interesting opportunities in that sector. Whether it's converting older facilities into new kind of warehousing logistics, or some ground up in the right markets, as well as repositioning retail assets into industrial, which has been interesting. With the right retail, obviously, in the right locations.
Right. Similar question for you, Stu. I think through an affiliated entity, AFA, you guys control a pretty substantial Class A stabilized office portfolio. Maybe can you tell us a little bit more about that strategy? It's pretty focused in a certain area. Why do you guys like the asset class? Why do you guys like Philly, which is obviously your backyard?
For sure.
How does it fit in with some of your clients' portfolios?
Really, the focus in our market is primarily because we're here. We know the office markets and the properties pretty well, and why step out of our box when we consider ourselves experts at it, and that's what we use other people for sourcing deals outside of our geography. Our strategy is pretty straightforward. We currently own and operate roughly we own 6 buildings that are valued about $200 million in the Philadelphia area. We've focused on suburban Class A real estate, office buildings. The goal here is to really almost like a pair trade in buying a real estate property versus buying a bond. Our tenants are major Fortune 500 or Fortune 100 companies or government agencies or hospital groups where in that their public credit is available, and the public credit, which is junior to a lease, is trading at quite a steeper price. So to buy a bond, a municipal bond for the hospital group that we own their building is what, 170 basis points for 7 years, whereas you can buy their lease and we bought it off of a mid-7 cap. So we like that return profile. We like our tenants. We invest in kind of mission critical space, and with that, whether their C-suite is located there or their data centers are located there, we're looking for those key components to make sure that real estate is crucial to them, whether or not they're working at full capacity right now with people in the office or working remote. We still believe that the majority of tenants out there are going to need a good amount of space just to collaborate with their people, and we want to make sure that our space is that that one space that they would keep if they have several in the area. But in general, it's a good centralized location towards their business interests. So we've had, the only thing we've seen recently with COVID, we've seen, an uptick in like renewal requests, mainly people coming in to try to renegotiate under good terms, feeling they could get a little soft spot with COVID. We've seen a little bit lighter leasing activity. People aren't really shopping around as much. It's difficult with COVID and to the prospect of building out space, and they might as well wait if they don't have to. But for the most part, our business has been pretty smooth. We've acquired 2 properties during this time period, and we're looking for more if the deal's right. Like previously mentioned, I think we haven't really seen much distress. There's more people trying to top tick the market and say, hey, we did a great job over the last couple of years. We got all these great leases. Let's sell now before some people start trying to weasel out of their leases or something like that. And that's really, that's really what we're focused on. And I think for our investors, the ability to get more income, tax efficient income, is really why we do what we do.
Yeah, thanks, Stu. So it sounds like you tend to use real estate as a potential yield.
Yeah, it's a bond replacement strategy. It's fixed income replacement. You're getting nothing from a treasury bond or a municipal bond, and you're getting something from a bond-like structure within the real estate. It's an asset-backed bond, right? So that's our trade-off there, and we feel that it's a really a compelling story to tell for clients and for for the rest of the world to try to get them to be clients.
So what percentage, I guess, would you say is average of real estate inside clients' portfolios?
Probably, anywhere from 10 to 20, 25%. Obviously, as fiduciaries, we can't really advocate for them to put most of their net worth in illiquid real estate partnerships. But when you look at it on the grand scheme of things, a lot of people have a lot of their liquid net worth in illiquid businesses that they own. So for us, it's really client dependent on how much they're comfortable with. We also have some varied pieces within our structure, within our cap structure, where clients can participate on the debt side of the deal and on the equity side of the deal, so that they're able to stack things up for liquidity purposes and income thresholds. It really depends on the client, and our goal is to try to use it as a kind of alternative bucket mixed in with some other strategies that we like outside of the real estate world.
Yeah, great. Thanks, Stu. Just a heads up, everyone who's listening. Sam from Walker Dunlop just sent me a note saying he had to hop. So if you have questions for him, feel free to pass them along to Kevin, and we'll get those answered for you. Ed, let me bring you back into the conversation. I noticed Gray Harbor's been pretty active in 2021 already, especially the last couple of weeks. Can you briefly describe one or both, of the assets that you've recently acquired and why they were a good fit for your overall strategy.
Sure, thanks. And I think, the general themes here are similar, obviously, to the many comments that Stu made about, reliable income, fixed income alternatives. And sounds like he even has some federal government tenants potentially in their portfolio as tenants. And so all we've done is taken that component, obviously, and just hyper focused on it. That's all we're doing. A perfect example of a property that we just acquired is a VA property. It's an outpatient clinic. This is in a typical, market that for us, typical being secondary, tertiary market. It's in Nebraska, about an hour and a half outside of Omaha in Norfolk. But it serves one of the nice things about the federal government is we don't necessarily question, their rationale for why they have to be. We want to, confirm demographics and make sure that the trends and the growth and the populations are there to support customer-facing type agencies such as VA or Social Security Administration, immigration type services. But when we look at a property like that, so this was a deal that's sort of typical. We buy between $5 to $20 million property size to create diversification. We don't believe in owning, that these are great investments to own one, given that they're single tenant and the result is binary on the renewal. It's better to have a portfolio of these and to, to construct that portfolio to create your NOI increases through kind of similar like a laddered bond portfolio. So the VA that we just acquired is a 15,000 square foot facility outpatient clinic. I like VA as a agency to acquire. They've got a big mandate for growth. They're certainly agnostic politically. Everyone really supports services that are going to veterans in this country. And the nice part about the VA clinics is you're getting not only the federal government credit, but you're also getting an asset that is also unique within federal government leased real estate, and that you've got medical build out as well. And so you've kind of, if you like medical office properties and you like the federal government credit, those two together, it's when chocolate and peanut butter come together here, right? So it's those are great assets that we like, but obviously not to allocate too much to any given agency. So we look to diversify that as much as possible across the portfolio, and we limit single agencies to 25% or less of the overall portfolio. That specific deal had a brand new 20-year lease. It was a build to suit property. For us, we do develop in-house. We have those capabilities, but the bulk of our growth will come through acquisitions. And so when we acquire a property like that with a 20-year lease in place, we're not doing any lease up front. We're strictly coming in and buying that federal government credit with the real estate asset associated with it. You mentioned we've done a few deals. We just closed another deal last week, which was a second generation 15-year lease renewal with the Social Security Administration Office of Hearings in Mississippi. Again, I think it highlights the location strategy of being in secondary and smaller markets where the federal government is relying on the private sector for their needs. But as we build our portfolio, and this is a new portfolio we're developing right now after the past two that I've developed over the last 11 years, the idea is to create agency diversification up front, but also location and to have early acquisitions and investments be in longer term leases, 10 to 20 years of total lease term remaining. And then we implement a barbell approach to our investment strategy that where we'll have 30% of our portfolio being shorter term leases where we're confident that a renewal will be achieved. And that allows us to get gets us to a quicker portfolio NOI growth, given that these leases are flat in nature typically. And so we can create NOI growth across the portfolio through specific property acquisitions and timing of those lease renewals.
I like that idea. That's something we do as well. Whereas we're looking at, when you buy a building and there's several tenants in there, you're looking for opportunities in the shorter leases to either renew or replace, preferably renew. And you're obviously looking at rents to make sure that they're they're at or below market, so that they can handle, the bumps or a renegotiation. And also you're looking to condition the property, so you're making sure they're not going to need a big TI budget, or there's not going to be a big broker commission that's cooked in there somewhere. So there's all little things that we look in the real estate world. And I do like your story there about the VA deal. Actually, I met a gentleman who develops a bunch of those a couple years back, and that idea really struck me, and I've been trying to get in touch with him. So I might hit you up later,
Sure.
just to kind of reconnect with that guy, or if he's the same dude who's doing it, because I feel like I was trying to introduce him to somebody else, and he kind of flaked on me. So anyway,
he's one of hundreds across the country.
Yeah.
Or if you've done some on the build to suit single tenant side, it is so highly fragmented. Local regional players who are winning these awards from the federal.
Yeah,
government.
he would really focus on the VAs entire,
Yeah.
the VA outpatient centers entirely,
Yeah.
and that was all he was doing. So maybe it's him, maybe someone else. Anyway, we'll go on to the next question, and I'll stop the tangent.
Speaking of next question, Mike, I don't want to step on any final questions you wanted to get to, but a couple did come in on the box. Would you like me to relay those, or would you like to move on?
Yeah, go ahead.
One question, it did come in for Sam, but I think possibly Ed or Stu have insights into this, and it does tie into some comments we heard from the prior panel around malls and interesting things people are doing there. So the question was, what do you see in the future for traditional mall assets? And we've heard interesting things around converting vacant department store space into industrial for like Amazon distribution, or converting into hotels. I've heard a fair amount separately about event related efforts. So experiential. What do you think? What's your crystal ball say?
I'll just jump in real quick. My crystal ball is never very clear, so it's I try not to look at it too much. But on the mall side, I think there's a tremendous opportunity for these dark facilities, obviously, to be repurposed. There's no rocket science there. I think it's going to be looking at best and highest use and the demand that's out there. And so I think they certainly lend themselves to either industrial conversion, and I think there's also a great opportunity for multifamily conversion of dark mall spaces. And lastly, I think even within our own sector in the government real estate space, federal spaces, federal government has moved in some regards to more of refit to suit facilities versus build to suit, because the cost can, you've got a lower basis in the property and you're starting off with some structure that can be reconverted or brought up to the specs of the specific agency. And so we've certainly seen in some of those locations, or in large strip with big boxes, where the box will get converted to a VA outpatient clinic or a Social Security Administration, maybe a lower level security type agency that doesn't have the same setback requirements or security needs that an FBI or a DEA facility would have. But we're certainly seeing opportunity for federal government leased real estate tenants to go into refit to suit in those types of large strip or vacant mall locations.
Yeah, thank you. And as it moves to Stu, there was a related question around AMC theaters raising around $1 billion last week, which was needed. And, so any input around the entertainment or consumer facing real estate turnaround was the nature of that question, which ties in with what I said.
Yeah, I'm seeing a lot of, redevelopment, a lot of, alterations in properties. We have one mall that kind of shadow space that's being converted into a supermarket. We have industrial space. We've seen multifamily development kind of plugging in with kind of a city center type feel around a mall. So I'm not so sold on the movie theater model going forward. It's going back to business school, we had several case studies about how movie theaters work, and they really just make their money on the concessions. And there's so much, the content is it's just so expensive for them to acquire and produce. And you've seen what's happened recently with with Netflix and Amazon and HBO Max making deals with the studios to release their movies direct on screen, direct in streaming. Right at the same time they're going on the theaters. There is something great about seeing a movie in a movie theater, but there's also great about the convenience of being able to watch it on your TV. So I think it gives them a lifeline. I don't know how long that lifeline will last. It may give them the ability to recreate their business model a little bit, and try to make some use of some dead space in the theaters, because they're generally pretty big footprints and generally not super full except for the top selling movies. So that's all I have to really say about that. The entertainment part of it, retail is another thing. I think retail isn't really going anywhere long term. We're seeing most of the companies that were having trouble before the pandemic are having more trouble, and ultimately, the Chapter 11 filings were not businesses that were put out of business by COVID. They were already kind of hanging by a thread, in my opinion. So I think that retail will be back. I think people like going out and shopping. The stuff, again, I'll reiterate, the stuff that was in trouble before will still be in trouble, and I think those that had a strong balance sheet beforehand will be able to bridge the gap and survive going forward. So I know I didn't entirely answer that question, but I did my best.
Now that makes a lot of sense. And Mike, we're out of time, so do you have a final note or question? There's a lot we could talk about.
No, again, thanks for allowing us to participate. Thank you, Ed, Stu, Sam. Appreciate everybody's insight, and yeah, have a great day.
Thank you very much.
Thank you, Mike, Stu, Ed, everyone. And with that, folks, I'd like to thank all of you listening in. Really appreciate it. I'd like to thank all of our speakers. Reach out to me if you have additional questions. We can't get to everything, trying to be efficient with your time. And thanks for joining today. Our next webinar will be on April 7th, and you can sign up. I'll be sending follow-up emails with links to sign up, and you can go to the website at Private Markets Insider. We'll be announcing more details, and we're actually open to speakers and ideas. We try to be a little bit real-time focused as we develop these things. So, we don't have it all pre-planned for the year. We're addressing things as they come up. Feel free to reach out. Private Markets Insider here is a platform for identifying investors, funds, deals through relevant content in this community. So feel free to reach out and chat about what you're seeing, what you'd like to see. And I may follow up with some of you to chat about deals and funds that may fit your interests. And meanwhile, I sincerely hope you stay safe and sane out there. And that's it. Bye, everyone.
Thanks, Kevin.
Thanks, Kevin.